Oliver, for me, news on Thursday that European banks have taken only 130 billion euros of funding from the European central banks targeted long-term refinancing operations. So that's only half of what it offered. For me, that is extraordinarily good news. This abject failure can only mean that the ECB will launch QE very early next year, and my entirely imaginary holding of Italian bonds will do very well out of that scenario. So let's celebrate. Yeah.
In the long term, I'd have to agree with you. For the moment, it tells another tale of woe in the Eurozone. The banks haven't taken much of this very cheap money at just 15 basis points for 4 years. This really is very, very cheap money. And it kind of gives credence to the banks' position. The reason they're not lending is that there's no demand. And there's plenty of supply available. Presumably, if there was demand, then the banks would take all this extra supply of money and lend it on and make a nice fat margin in the middle. So perhaps it lends credence to that view that there's no demand, which is another sign of how awful the Eurozone is. Like you say, though, it does suggest that the options for the ECB are running out, and it will have to try full-blown QE fairly soon. So yes, load up on more of that Greek debt, or that Italian debt, perhaps.
Well, I mean, we can include Greek debt as well. Yes. Yeah. But I mean, the last TLTRO, banks largely paid off debt using the funds supplied. I mean, with this one, like you say, they have to say they'll lend it to businesses at some point, but they don't actually have to say what businesses for a bit longer still. So, I mean, really, why wouldn't you just, it's 4 years of 15 basis points funding, just take it as a sort of rainy day fund?
Because that's an expensive fund to have if you have to deposit with the ECB because you can't find anywhere else to put it. That's a very expensive thing to do. So you don't want to have too much liquidity sloshing around in your bank. So you wouldn't really take it unless you really need to. Now, in some areas there is a reason to take it, and last time when we had a bit more of a breakdown of who'd taken what after a while, you could see it was banks on the periphery that took the money in Italy and Spain in particular, and their deposit costs are very high. So if the banks can replace this fairly expensive deposit funding with very cheap ECB funding, then perhaps there's a chance they might be able to lend it on, cut the rates on lending to small businesses, and perhaps boost a bit of volume that way.
Okay, and now very quickly, I mean, it's a few weeks after, or months actually, after the stress tests revealed a few capital holes, but not as many as people were expecting. Does this less than stellar take-up suggest actually there is still a pretty big capital problem out there?
Well, that's what credit analysts at RBS would argue. They say that the reason they're not taking it is because of a lack of capital, and that you could take all this liquidity in the world, but the banks are still very capital constrained. They don't want to take the risk of lending to small businesses because they don't have the capital. And as long as that's the case, there still won't be much lending to small businesses, in which case we should perhaps steal ourselves some more fundraising in the future.
Or for some more QE.
Or for some more QE.
Thank you, Oliver.